A student once asked her master how to make money in the stock market. The master replied, "Well, that's easy. Just identify a few stocks that are going to go up and you are sorted." The student scratched her head and wondered, "But how does one identify stocks that are going to go up?" The master took a deep sigh and replied, "That's not easy. I've been trying to figure out that for the past 20 years. The master is right. In the stock market, picking good stocks is one thing, and picking good stocks that are also going to go up is another. Little surprise then that stock investors often find their stocks going nowhere or going downhill when the rest of the market seems to be doing just fine. And why just stock investors? Fund investors can also witness this phenomenon in their portfolios. This task of identifying well-performing stocks is further complicated by the fact that there are over 5,500 listed companies if we consider the BSE. Now, is there a way out? Yes, and we are going to talk about that in today's video. Hello and welcome to ET Money's YouTube channel. Today, we will discuss how you can use sectors to arrive at promising stocks. Now, unlike the number of stocks, the number of sectors is quite limited, and by thinking in terms of sectors, you can simplify your task a lot. Not just this, by focusing on sectors, you can also reduce the chances of investing in a stock that goes nowhere or falls when other stocks are racing. Now, this technique of shifting your portfolio as per sectoral trends is called sector rotation, and we will discuss it in detail today. Now, this video belongs to our playlist on how to pick stocks. To explore similar videos, you can explore it. The link is in the description. Okay, now this video is divided into two parts: why sector rotation matters and how you can do it. Let's begin with the first one. Sector rotation is important because different sectors of the economy do well at different times. For instance, in 2024, the real estate, telecom, auto, and capital goods sectors did well. In 2020, the best sectors were IT, healthcare, and consumption. In 2016, the energy sector stood out at the top. Quite naturally, when a sector does well, the stocks belonging to that sector also do well, or vice versa. So, by focusing on sectors that are in a sweet spot, you can pick stocks that are poised to do well. And that's what makes sector rotation an appealing technique. Now, as discussed at the start of the video, focusing on sectors also helps in shortlisting the most deserving stocks from the thousands of options available. It also reduces the chances of being invested in stocks that don't enjoy tailwinds or that actually suffer from headwinds due to the economic or business cycle. But why do different sectors do well at different times? Let me explain with an example. In geography, you would have read about the tectonic plates under the Earth's surface. The movement of these plates has resulted in the formation of the continents and oceans that we see today. Like these plates underpin the movement of land masses, economic or business cycles are often responsible for market movements. The typical economic or business cycle has four phases: recovery, expansion, slowdown, and contraction. Now, these four phases are characterized by varying levels of economic and business activity. Different sectors and stocks gain prominence depending upon where we are in the business cycle at the moment. For instance, during the recovery phase, the sectors that gain prominence include financials, consumer discretionary, real estate, and metals. This happens because economic and business conditions are conducive to these sectors. Similarly, when the economic cycle goes through a slump, the sectors that stand out to benefit include IT, consumer staples, pharma, and utilities. Now, these sectors are defensive in nature, and hence when the economy is slowing down, they tend to be better than the rest. So, the economic or business cycle is a reason why different sectors do well at different times. Now, this brings us to the second part of this video. How can one apply the technique of sector rotation at the portfolio level? Let's now see that in the next section. At its core, the techniques of sector rotation is about identifying which sectors are favorably placed at the moment and then investing in them. One can use fundamental factors to pick such sectors, or one can take a tactical route. Now, since the idea is to rotate sector, it's important to also change sectors from time to time. The first And the most straightforward way to pick winning sectors is to track economic and business indicators. There can be multitude of economic and business indicators, and admittedly tracking them is not easy for the retail investor. But getting a sense of some of them can help you assess where we may be in the business cycle and consequently pick appropriate sectors and exit the inappropriate ones. Now, some of the indicators that you may want to keep on your radar are economic activity, credit growth, capital expenditure, interest rates, corporate earnings, etc. In an expansionary phase, the economic activity starts to rebound, credit growth starts to rise, capex increases, interest rates start going down, corporate earnings start to improve. Amid such conditions, financials, consumer discretionary, real estate, metals tend to do well, as economic and business conditions are conducive to them. IT, consumer staples, and pharma tend to take a back seat as the focus shifts away from defensives to cyclicals. Now, as the cycle hits the peak, economic activity starts to stabilize. Interest rates start to rise to tame inflation, corporate earnings are strong, and unemployment is low. Amid such conditions, sectors like financials, consumer discretionary, energy, and metals tend to be in the forefront. However, as the cycle subsequently enters into the contraction and slump phases, these indicators reverse course as well. Amid such conditions, defensive sectors like IT, pharma, and utilities should be your choice. Now, this is a fundamental way of assessing the economic or business cycle and rotating sectors based on that. Similarly, one can also check sector and industry-specific metrics to understand how a sector is positioned at the moment. The profitability drivers of some key sectors are on your screen for reference. Now, the next strategy is to pick sectors based on growth. Sectors that are favorably placed at any given point in time enjoy above average growth rates. The opposite is true for sectors that are suffering at a point in time. Now, one way to assess if a sector is growing reasonably fast is to compare its revenue growth with the growth in nominal GDP. Now, India's nominal GDP growth for FY25 is estimated to be 9.9%. Let's see which sectors have revenue growth more than 9.9% and which have a lower number. The sectors that stand out include realty, consumer durables, finance, capital goods, and healthcare. The laggards are metals, FMCG, utilities, oil and gas, and IT. Now, another way to highlight outlier sectors is to check its performance versus estimates. If a sector beats its earnings estimates, it can be a potential outperformer, as seen in the case of IT and metal sectors post FY21 results and the PSU and telecom sectors post FY23 results. The next strategy is the classic way, selecting sectors based on returns and valuations. A rather simple way to shortlist sectors is to look at the near-term returns, say last 1 year returns. Then compare these returns with the returns of a market index such as Nifty 500 or the BSE 500. This will give you two sets of sectors, those that have done better than the market index and those that have lagged behind. Now, I can use the former set to ride their momentum and the latter set to tap value or take a contrarian bet. For instance, over the last 1 year, the sectors that have done better than the Nifty 500 include financial services, pharma, and consumer durables. Those that have significantly trailed the Nifty 500 are media, energy, and realty. So, to ride momentum, an investor can take exposure to the outperformers. The same investor can allocate part of the portfolio to laggards to take a value or contrarian bet. Now, you can also go a bit deeper by assessing the valuation of sectors versus the market valuations. For instance, consider the relative valuations of the pharma sector and the Nifty 500 in terms of the price to book or the PB ratio. Now, we have considered the PB ratio as it's a relatively more stable metric than price to earnings or the PE metric. The pharma sector's PB premium hit a high of 47.4% in December 2024 and a low of just 1.2% in September 2022. The pharma sector PB has a median premium of 18.8% over the Nifty 500 PB. The current premium of 36.6% is much higher than the median. This suggests that valuation-wise, the pharma sector is quite expensive. And what about the IT sector, which has been in the news for quite some time due to its subdued business performance? The IT sector has always stayed at a steep premium to the Nifty 500 in terms of the PB ratio. Now, that isn't surprising as IT is an asset-light sector and hence IT companies typically have high PB ratio. But what we are interested is not the absolute PB but the relative movement of PB of the IT sector versus the PB of the Nifty 500. The premium of the valuations of the IT sector touched a high of 178.7% in December 2021. It touched a low of 59.2% in June 2024. Now, as against the median premium of 104.3, the current premium stands at 93.2. That makes the IT sector a potential bargain. But before you draw any simplistic conclusions, here's something important. Sector and stock valuations are more of a function of future expectations rather than the past multiples. So it's important to club the return and valuation pictures of sectors with the assessment of business prospect to take a call on whether the momentum can sustain or the value can be unlocked. Okay, now let's talk about the next strategy, playing the long-term cycle in sunrise sectors. Certain sectors or industries or themes enjoy long-term tailwinds and can be thought as being in a long-term upcycle. These include niche industries like semiconductors, EMS or electronic manufacturing services, EVs, green energies, etc. And themes like China Plus One, Make in India, financialization, urbanization, etc. Now, picking companies belonging to these industries and themes can prove to be rewarding in the medium to long term. Similarly, some mainstream sectors can also provide secular growth for years to come. For instance, the telecom upcycle is expected to last for several years, given the ample room to increase ARPUs or average revenue per user for the foreseeable future. Given the rising share of consumer discretionary sector within consumption space, the consumer discretionary upcycle is also expected to continue for years to come. Also, low bed densities and a rising elderly population bode well for the healthcare sector. Now the question here is how the idea of rotation applies to sectors that are in the long-term cycle. Now within sectors or themes that are in long-term upcycle, you can rotate segments or industries from time to time that are poised to do well. Examples of some segments within some broad sectors are on your screen. Now, like long-term cycles, one can also place short to medium-term cycles that sectors keep exhibiting from time to time based on policy-related developments. For instance, localization in defense kickstarted the cycle in defense. The recent India-Pakistan conflict has brought defense stocks into focus again. Seasonality in business performance can also be an opportunity for a sector rotation. For instance, AC manufacturers tend to report better performance during the summer seasons. This is seen in the sales numbers of Voltas, which typically tend to be higher in March and June quarters as compared to the September and December quarters. So, our strategy could be to invest in them during the off-season and sell out during the peak season. Similarly, other sectors like hospitality, chemicals and fertilizers, jewelry, power, cement, etc. also show seasonality in demand, which makes them good candidates for sector rotation. Okay, let's summarize what we've discussed in this video. Sector rotation is a sophisticated method to pick stocks that lies at the intersection of fundamental and tactical styles of investing. One other simple way of seeing it is to switch sectors between cyclicals and defensives. Cyclicals are those sectors whose growth depends on economic growth, and defensives are those sectors whose growth is independent of economic growth to a large extent. So, when the economy is firing on all cylinders, you can bet on cyclicals, and when the economy seems to be losing momentum, you switch to defensive. Of course, this switch is not an all or nothing game. Rather, you should see it as a continuum across which you are making strategic shifts. Quite naturally, doing so will require ample commitment and interest, so you should indulge into sector rotation only if you have time and can make the required efforts. The rewards would be in terms of potentially higher success rate and hopefully better returns than the buy and hold style of investing. But remember that selecting stocks is just the first step. It's also important to show proper due diligence in picking stocks. That means picking fundamentally good stocks and not those with shaky financials. Also, don't ignore company-specific factors when you pick stocks. A company that's going through its own problems may not help you play a cycle. You can also opt for index funds or ETFs to take sectoral bets. This method is simpler than picking stocks and also comparatively less risky. Last but not the least, if you are a mutual fund investor, you can do without taking calls altogether. Remember, it's your fund manager's job to pick winning sectors and rotate them, and you're already paying him for that. And with this, we have come to the end of this video. I hope you found it useful, and if you did, please share it with your friends and family. I'll be back soon with another video. Till then, take care.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.